In 2002, WorldCom admitted it had faked $11 billion in profits. The stock collapsed. On paper, the business looked healthy. In real life, the cash was drying up. That's the part numbers on a glossy report can hide. For a while, but not forever. And that same trap shows up in trading. Your screen can look fine right before reality sends the bill. So what was the trick? Put that in the home upgrade folder. Sounds harmless. Until you see what the bill actually was. You grabbed paper towels, cereal, and toothpaste on the way home. Total, $47. Later, you sit at the kitchen table with a coffee and two folders. One says, stuff I used up this week. The other says, things that improve my life over time. A desk, a laptop, a washing machine repair. Slide the grocery receipt into the second folder. Suddenly your monthly budget looks better. The everyday spending pile shrinks. You can tell yourself you were being responsible, but nothing real changed. The money still left your bank account. The cereal still gets eaten. By next week, it's gone. Now stretch that little trick into a giant company. WorldCom took normal operating costs, mostly line expenses for its telecom network, and treated them more like long-term investments. In plain English, they took a bill from the Used Up Now folder and moved it into the Helps Later folder. That made profit look higher on paper because the cost didn't hit all at once. But cash doesn't care about your folder labels. Cash already walked out the door. That's the whole game. A report can tell a neat story. Bank balance tells you whether the story can pay rent. In trading, you can tell yourself a smaller version of the same lie. Your app shows green on one position, a trade you currently hold. So you feel smart. Then you ignore the unpaid bill hiding underneath. Maybe your other positions are frozen. Maybe your capital, your trading money, is tied up. Maybe a loss is only being delayed. If this reframe helps, subscribe. 2 of these a week. The first payoff is emotional. You feel safer because the screen looks cleaner. But here's the ugly question. When your account says you're fine, what simple check tells you whether that's true or just clever filing? Your budgeting app says you saved $400 this month. Then rent hits tomorrow. Your car insurance is due Friday, and your checking account has $62. That feeling is the whole mistake. A clean number can calm you down before reality arrives. Companies do this. Traders do it too. Your account can show a gain while your actual flexibility gets worse. Say you enter a trade at 9:42 a.m. The screen shows green by lunch. You feel smarter already. But the trade is still open. Nothing has actually landed back in your account yet. And if your capital is tied up, that green number can vanish fast. Now add one more layer. Maybe you used leverage, borrowing money so you can trade bigger than your account size. Now a small move looks huge on the screen. Your P&L, profit and loss, the running total of money you've made or lost, looks impressive. But the money you have left to handle the next problem is shrinking, not growing. What's interesting, this is why neat dashboards fool beginners. They stare at the story number, not the survival number. The story number says, I'm up. The survival number asks a harder question. What cash actually came back? And what's still trapped in open positions, the trades you currently hold? That gap matters more than people think. A trade can look successful and still leave you stuck. Just like unpaid bills can wreck a month that looked fine on paper. So when numbers look polished, don't ask whether the report sounds good. Ask the harsher question. If the story says strength, what does the money itself say? Why do smart-looking numbers fool people so easily? Because a good story feels clean. Cash feels annoying. The story says, business is strong. Cash says, then why is the checking account gasping? You know this from normal life. Your paycheck hits on Friday. You feel fine. Then Saturday morning, the rent clears. The car insurance autopay fires. Your phone buzzes with a low balance alert at 8:12 a.m. On paper, you earned money. In real life, you still can't breathe. That's the split most beginners miss. A company can report profit and still struggle for cash. A trader can show a nice account screenshot and still be in danger. The report is the story. Cash is the receipt. Here's where the lie starts to feel smart. Say you run a small business. You spend money fixing up the shop. New lights, new shelves, fresh paint. That cash is gone today. But if you label that spending as a long-term improvement instead of today's expense, today's profit can look better. Nothing changed in the bank account. Only the label changed. That's why cash is such a brutal referee. You can move labels around. You can polish categories, you can stretch the story, but cash leaving the building leaves a trail. The same thing happens in trading. You can stare at your profit and loss, the running total of money made or lost. You tell yourself you're fine, because one open winner makes the screen look green. But that money isn't realized yet, and your other positions, the trades you currently hold, are bleeding. The green is fake comfort. You can also fake confidence with borrowed money. Say your capital, your trading money is small, but your exposure, how much of your account is at risk on a trade, is huge. The account can look bigger than your real cushion, for a while. Then reality asks for cash. That's the part paper stories can't dodge. Bills need paying, debt needs servicing, losses need covering. A broker does not accept vibes. Suppliers do not accept adjusted categories. The bucket either holds water or it leaks. And once you see that, the WorldCom story stops being an accounting scandal. It starts looking like something more familiar, a person trying to sound solvent while the drawer empties, which raises the question, what did their numbers say and what was the cash quietly screaming? It's the same edge a poker player has at the table, the discipline to fold a tempting hand when the numbers turn. By June 25, 2002, it was over. WorldCom said it had inflated its profits by $3.8 billion. That number later swelled to about $11 billion. For a while, the reports looked fine. Then the lights went out anyway. Back up a little. WorldCom was a giant phone company. In the late 1990s, it grew fast through deal after deal. On paper, that looks exciting. In real life, it creates a huge need for cash. Then the boom cooled off. The telecom market slowed. Customers spent less. But the company still had everyday bills to keep the network running. One of those bills was called line costs. Think of it like rent you pay to use someone else's roads. WorldCom paid other phone networks to carry calls across their lines. That was a normal operating expense, money going out the door right now. But instead of showing billions of those costs as current expenses, WorldCom shifted them into the bucket for long-term assets. In plain English, it treated a monthly bill more like a renovation than a receipt. From 1999 into 2002, that move hid losses. It made profit look stronger than reality. The fake calm worked for a while. Reported profits stayed up. Executives could still tell a clean story. But the cash kept telling the uglier one. By 2001, WorldCom reported about $1.4 billion in net income. That sounds healthy. Yet its operating cash flow, the actual money the business generated, was under pressure. The business wasn't throwing off money the way a healthy company should. The report said strength. The cash said strain. Then reality called. Internal auditor Cynthia Cooper and her team started digging at night. Not metaphorically, at night. They looked at entries that didn't make sense. They found billions parked in the wrong place. On March 11, 2002, the SEC asked questions. By June, the company admitted the misstatement. The stock collapsed. Thousands of employees saw retirement savings wrecked. On July 21, 2002, WorldCom filed for Chapter 11 bankruptcy. It was the largest bankruptcy in U.S. history at the time. Here's the trading lesson hiding inside that collapse. You can make a screen look impressive for a while. You can move numbers around. You can ignore an unrealized loss, a loss you haven't locked in yet. You can cherry-pick a time window. You can pretend your account is fine because one position, a trade you still hold, is open. But cash is harder to argue with. Cash is what actually arrived. Cash is what actually left. Cash pays the bill, covers the loss, and keeps you in the game. That's why bad situations often sound good right before they break. The story can be polished. The spreadsheet can be polished. The account screenshot can be polished. But if money keeps leaking out, reality is already on the phone. WorldCom didn't die because one report looked messy. It died because the business needed real dollars, and the real dollars weren't there. So here's the next question. Ask it every time a company, a guru, or your own account looks great on paper. What 3-item cash test would catch the leak before the collapse? A screenshot can lie. A cash balance is harder to fool. So give yourself one simple rule. The 3-question rule. Quick aside, if this helps, subscribe for more like this. Before you trust a company, a trading account, or a guru's results, ask 3 things. First, did real cash come in? Not reported profit, not a pretty percentage, real dollars. If the story says business is booming, but the checking account keeps shrinking, that's a warning. Second, where did that cash come from? Did customers pay for something real, or did it come from borrowing, selling assets, or shifting money between buckets? Cash from actual business is different from cash borrowed to keep the lights on. Third, can it happen again? A one-time burst can make a month look amazing. A tax refund, an asset sale, a lucky spike. But if the cash only showed up once, you do not have a durable engine, you have a moment. That is your cash reality test. Real cash in, source of cash, repeatability. Use it on everything. A company report, a finfluencer, an online influencer who gives financial advice screenshot. Even your own P&L, profit and loss, the running total of money you made or lost. If the number looks great, but cash is missing, treat the story like wet cardboard. And once you start using that test on your own account, one uncomfortable pattern usually shows up first. Next time your account looks better than your bank balance feels, stop. Do one thing. Trace the actual cash. Where did money leave? Where did it come back? That habit catches self-deception early. It stops a small leak before it becomes a real problem. Want more simple rules like that in your feed? Subscribe. The next breakdown is about the ugliest lie traders tell themselves when a losing trade still looks fine.